Welcome back to the Dinar Daily, your dedicated source for tracking the latest developments surrounding the Iraqi Dinar (IQD), the Vietnamese Dong (VND), and the dynamic landscape of global currency shifts. Tonight, we delve into a topic that has commanded the attention of currency holders across the globe for years, a development so significant it warrants a careful, in-depth look. We're focusing on the confirmed reports circulating within the financial world that suggest a major operational shift is underway concerning the exchange rates for both the Iraqi dinar and the Vietnamese dong. For many, this moment represents the potential culmination of years of patient observation and belief in the underlying economic strengths of these nations. The anticipation that has long surrounded these currencies stems from a fundamental conviction that their market values have been artificially suppressed or simply lagging behind the true, measurable economic progress being made in their respective nations. Imagine holding a financial instrument that many critics have dismissed, only to see it potentially enter a phase of historic validation. This sentiment captures the collective experience of countless individuals who chose to acquire these notes, often years ago, believing in the future economic correction. The current wave of information suggests that this long-awaited realignment is transitioning from theoretical discussion to tangible, verifiable financial action across global systems. The discourse around the Iraqi dinar, in particular, has been a central fixture in international financial discussions ever since the profound geopolitical changes that followed the 2003 conflict and the subsequent internationally monitored restructuring of Iraq's financial sector. The core argument supporting a dramatic valuation increase has always rested on Iraq's immense and virtually unparalleled natural resource wealth. The nation holds some of the world's most extensive proven oil reserves, a fact that fundamentally positions it as a major, inescapable player in the global energy market and provides a strong, quantifiable backing for its currency's potential strength. This oil-backed potential is inextricably linked to the possibility of a more stable economic infrastructure, increased global trade, and strategic international partnerships. The belief is that these factors would inevitably underpin a significantly stronger currency on the international stage, far exceeding its current trading value. This unwavering conviction has birthed and sustained a dedicated global community of observers and currency holders, often referred to as the IQD speculation community, all united by the hope of a dramatic financial transformation spurred by a currency revaluation (RV). A very similar pattern of belief has simultaneously emerged regarding the Vietnamese Dong. Vietnam's economic trajectory has captured the attention of analysts focused on rebalancing emerging market currencies. Like Iraq, Vietnam has traversed years marked by economic difficulties, hyperinflationary periods, and strict financial controls. The dong underwent repeated devaluations historically, leading to the long-term hypothesis that, as the Vietnamese economy matured, became deeply integrated into global supply chains, and established itself as a manufacturing powerhouse, its currency would eventually undergo a sharp, upward adjustment reflective of its new, competitive economic reality. Despite being vastly different in geography and political structure, Iraq and Vietnam share comparable historical narratives of post-conflict rebuilding, navigating sanctions, and implementing methodical, long-term economic reforms. The shared trajectory of reform and economic maturation is what sustained the belief in an eventual revaluation across both currencies. Currency holders, who often purchased physical notes through various currency dealers, maintained their holdings through years of speculation, missed predictions, and the cyclical disappointments of unfulfilled rumors, demonstrating extraordinary patience and commitment to their initial investment thesis. What has changed now is the nature of the information flow. A current surge of credible reports, purportedly stemming from banking insiders, official government communications, and even confirmed internal bank communications, suggests that the speculative phase is yielding to an actionable reality. These reports insist that final exchange rates have been formally approved and are being integrated into financial systems. This is being presented not as mere speculative chatter from online forums, but as a development reportedly corroborated by data streams actively appearing within major banking networks worldwide, indicating a coordinated financial event. According to these emerging details, large financial institutions, including significant U.S. banks, are reportedly undertaking internal synchronization of their exchange platforms to reflect these updated currency valuations. Some early accounts from sources in private banking suggest that digital displays within these specialized financial offices are already registering the new, significantly adjusted higher values. The key takeaway from this specific detail is the claim that this is no longer a cycle of pure speculation, but rather an unfolding financial process being operationalized within the core of the global banking system. The question has shifted from if a revaluation will occur to what now, regarding the implications of this claimed historical event. With the intense speculation now reportedly giving way to verifiable, tangible financial developments, the most crucial details for all observers and holders center on the specific numbers being reported. According to sources that claim to have close ties to the Central Bank of Iraq and updated intelligence flowing into global financial institutions, the Iraqi Dinar $IQD is reportedly reflecting new, revalued figures. The reported range is approximately $3.85 to $4.25 per one IQD. This purported adjustment represents an extraordinary increase from the deeply suppressed, long-standing trading rates where the dinar remained at mere fractions of a U.S. penny for over 2 decades. Similarly, the Vietnamese Dong $VND is also displaying new reported valuation figures. These figures are circulating within a range of $2.50 to $3.40 per 1 VND. This is described as a proportional adjustment that places the currency at a level that was generally considered unattainable by mainstream financial analysts even a decade ago. These reported figures underscore the dramatic nature of the claimed financial adjustment, validating the long-term conviction of those who maintain their holdings. The sheer scale of the change is central to the narrative being presented by these sources. The conversation around the Zimbabwe dollar ZWL, introduces a more intricate situation. Due to Zimbabwe's well-documented history of catastrophic hyperinflation and its subsequent financial redenomination policies, the nation is reportedly pursuing structured agreements for its currency rather than a direct, single revaluation. Specifically, holders of historical bond notes are allegedly being offered negotiated payout windows. These arrangements are intended to provide compensation that attempts to balance the magnitude of their original holdings against the ongoing realities of Zimbabwe's complex economic restructuring and debt resolution efforts, making it a unique case among the 3 currencies mentioned. To fully appreciate the scope of these claimed changes, one can look at a specific example, a 25,000 Iraqi dinar note, which was often purchased by smaller retail investors for less than $50 USD in the post-war years, could potentially be worth over $100,000 USD, even at the lower end of the currently reported range. Such numerical leaps are described as staggering, leading proponents of the revaluation to characterize this moment as a potentially massive transfer of wealth in modern financial history, affecting individuals across all economic brackets. Reports suggest that banks in the United States have already initiated a meticulously structured, staged rollout of these currency exchanges, a process organized into a series of tiers. The first to access these revalued funds is purportedly Tier 1, which is said to be reserved for major government bodies and highly exclusive financial clients. Following them is Tier 2, which reportedly includes major corporations and large institutions that have pre-arranged agreements with the respective central banks. Next in the sequence is Tier 3, which is described as comprising large private investor groups, sometimes internally referred to within the currency community as whales. Finally, Tier 4B is where the vast majority of ordinary, everyday retail currency holders are expected to fall. This staggered, multi-tiered approach is reportedly put in place to ensure that the process does not create systemic chaos within the financial system, allowing for the effective management and measured distribution of immense liquidity. The essential difference between this current wave of information and previous cycles of rumor is the claim that the final exchange rate has transitioned from a number merely discussed in online chat rooms to an operational, actionable financial reality. Major banking institutions are reportedly no longer dismissing the possibility of a revaluation. Its existence is allegedly being confirmed and reinforced by a series of coordinated system upgrades and verified internal banking documentation. This alleged movement from theory to institutional action marks a significant shift in the narrative for the countless individuals who have patiently held their currency notes for many years. This moment is being framed as far more than just a realization of potential profit. It is widely viewed by this community as a potential doorway to newfound financial independence, the creation of generational wealth, and the realization of opportunities that previously seemed unattainable. While there are still expected to be questions regarding taxation, specific redemption procedures, and potential post-exchange restrictions, the core claim being made is that the long-debated revaluation has now crossed the threshold from speculation into established fact. From a broader macroeconomic perspective, the revaluation of the Iraqi dinar and the Vietnamese dong is being strategically positioned as a move toward greater alignment with the overall currents of global finance. Iraq, for example, has spent the last 2 decades meticulously rebuilding its core economic infrastructure. The country has significantly increased its foreign currency reserves, reportedly exceeding the necessary thresholds required to stabilize its exchange rate and inspire global investor confidence in its fiscal strength. Concurrently, Iraq has also made strategic moves to strengthen its geopolitical partnerships. This has been achieved by securing long-term oil supply contracts with major global economic powers, notably China and India, while also expanding its trade presence in European markets. These are presented not merely as simple trade agreements, but as long-term financial guarantees that are expected to generate predictable, sustained streams of revenue for decades, providing a solid, fundamental bedrock for a stronger currency value, given that oil remains the definitive backbone of global energy. Iraq's position as a holder of some of the largest untapped reserves gives it immense leverage on the world stage. By raising the value of the dinar, the nation is reportedly not only restoring significant purchasing power for its domestic population, but is also sending a powerful, unambiguous signal of financial sovereignty and newfound economic stability to the entire international community. The revaluation in this context is not viewed as a random financial act, but as the logical result of deliberate, strategic planning to reintegrate the nation into the global economy on stronger, more equitable terms. Vietnam offers a slightly different, though equally compelling, economic narrative. Over the past 3 decades, the country has undergone a remarkable transformation, evolving from a post-war state to one of Asia's most dynamic and competitive manufacturing hubs. As labor costs have escalated in other markets, Vietnam has successfully capitalized on the opportunity to attract multinational corporations seeking cost-efficient and reliable production bases. Today, the Vietnamese economy benefits from robust trade surpluses, increasingly diversified export markets, and a steadily more sophisticated, skilled labor force. From advanced electronics to mass-market textiles, Vietnam has effectively positioned itself as a crucial and vital link in the increasingly complex global supply chain, consistently earning both substantial foreign direct investment and high international credibility. Major global financial organizations, such as the International Monetary Fund, IMF, and the World Bank, are said to have a direct, vested interest in ensuring that the exchange rates for currencies like the Vietnamese Dong accurately reflect true market fundamentals rather than values that are artificially suppressed. A currency revaluation, proponents argue, assists in preventing distortions in global trade balances and reduces reliance on unstable or outdated currency practices. Vietnam's alleged revaluation is thus framed as a recognition of the nation's rising competitive stature, aligning its financial policy with its undeniable role as an emerging global economic powerhouse. For individual currency holders, the implications of these claims extend far beyond policy and macroeconomic trade theory. For many, this event is anticipated as the single most profound and dramatic personal transfer of wealth they will ever witness. Retirees or small-scale investors who held dinar or dong notes for years are reportedly facing the possibility of sudden, life-changing financial windfalls, potentially reaching into 6 or even 7 figures. For a segment of these holders, this represents the long-awaited opportunity for financial security in retirement, the chance to definitively pay off mortgages and eliminate debt, or to fund the advanced education of future generations. For others, it is the possibility of establishing generational wealth, a chance to create enduring legacies, charitable foundations, or new entrepreneurial ventures that could reshape not only their own families but also their immediate communities and regions. While the excitement surrounding these reported developments is palpable, so too is the need for caution. Financial analysts consulted by these sources are clear that the manner in which these new, potentially wealthy individuals manage their initial currency exchanges will be the determining factor in whether this moment becomes a fleeting episode of temporary good fortune or a sustainable, long-term financial blessing that resonates across generations. The complexity of the exchange process itself necessitates this caution and careful planning. The rollout of new exchange rates is reportedly not as simple as walking into a local bank branch and immediately trading notes for dollars. Structured payouts are increasingly described as a central feature of many exchange agreements, particularly for those individuals holding substantial volumes of currency. Reports speak of private banking offices, specialized contract rates tied to negotiated terms, and even dedicated, secure redemption centers being arranged to manage the massive anticipated flow of capital in an orderly fashion. Investors are being advised to carefully weigh the potential benefits of accepting a higher negotiated contract rate, which may come with specific stipulations or long-term financial commitments, against the appeal of opting for immediate liquidity at the standard public market rates. The claimed ecosystem of the revaluation is presented as intricate and demanding, requiring meticulous preparation, professional consultation with trusted financial advisors, and disciplined, strategic execution to ensure long-term stability rather than temporary gratification. The event, therefore, is being framed as more than just a financial transaction. It is also described as a significant test of preparation, patience, and financial prudence for every investor fortunate enough to participate in the reported exchange. Moving beyond the internal community, rumors and speculation requires listening to credible, recognized voices within the economic, banking, and policy communities to ground the analysis in verifiable fundamentals. Dr. James Farrow, an economist at the Global Trade Institute, as quoted by these sources, reportedly provides one such perspective, stating that the Iraqi dinar's rise is fundamentally backed by solid economic indicators. He points to Iraq's sustained oil exports and its dramatically increased international trade reserves as justification for a stronger currency, arguing that the revaluation is fully aligned with the nation's long-term fiscal health. This assessment attempts to assure that what is unfolding is firmly tethered to real-world financial groundwork rather than pure speculative wishful thinking on the investor-facing side. Linda Hayes, a seasoned currency strategist based in New York, according to these reports, adds a layer of pragmatic guidance. She cautions strongly against viewing the revaluation as a mere lottery ticket, a phrase often used to describe purely speculative holdings. Hayes emphasizes the need for discipline, foresight, and a defined strategy, advising investors to view this as a disciplined opportunity where sustainable wealth can be created if managed correctly through structured programs and contract rates. This advice underscores the critical importance of financial literacy and making careful, well-informed decisions. Many investors who suddenly find themselves with potentially life-altering sums may be tempted toward impulsive spending or unstructured investment choices. Hayes's warning reflects an understanding of human behavioral finance, stressing that sudden wealth can either lead to long-term stability or rapidly vanish if not handled with immense care and professional guidance, providing an alleged insider's confirmation. Michael Adams, a former executive with years of experience in U.S. banking operations, as quoted by the sources, offers what is presented as the most tangible validation for skeptics. Adams reportedly states that the U.S. banking system has already fully integrated the new IQD and VND values into their core terminals. He asserts the rates are not hypothetical. They're live. This is claimed to be highly significant because banking integration requires coordinated, systemic updates, compliance checks, and institutional approval, all of which are cited as concrete evidence of legitimacy and operational reality. Adams's testimony reportedly indicates that major financial institutions are not merely preparing, hypothetically, but have already adjusted their entire platforms to reflect the new valuations. For currency holders, this is claimed to signify that the revaluation has moved past the stage of purely theoretical discussion and is now being operationalized within the very heart of the global banking network. The convergence of these expert perspectives from economic fundamentals, investor discipline, and banking infrastructure provides a compelling, unified conclusion. The currencies of Iraq and Vietnam are reportedly undergoing a historic, verifiable transformation. For those preparing to participate in the reported exchange process, a final set of practical considerations is deemed essential. The very first step is verification. Investors must ensure their IQD or VND notes are authentic. They're advised to have purchase notes from licensed, registered currency dealers who provided proper documentation at the time of purchase, as counterfeit notes remain a significant risk that could lead to outright denial at exchange centers following verification. The second critical priority is proper documentation. Banks and redemption centers are reportedly requiring government-issued identification, proof of address, and potentially original receipts or certifications, especially for high-volume holders whose transactions may trigger mandatory regulatory reviews. Understanding the tiered exchange system remains equally critical. While large holders, tiers 1 to 3, are reportedly accessing appointments and contract rates now, Tier 4B retail investors must prepare for their slower, scheduled, yet assured participation. The appointment system itself is widely expected to operate under strict confidentiality measures. Many of the designated redemption centers are rumored to be functioning under non-disclosure agreements, meaning investors will likely be asked to maintain absolute discretion regarding the specific rates, exchange procedures, and even the locations. This measured, controlled approach is deliberately implemented to prevent panic, ensure order, and effectively manage the massive liquidity involved in the entire process. Finally, one of the most essential and often overlooked aspects is compliance. The tax implications of these massive currency profits will undoubtedly vary by jurisdiction, but in virtually every case, profits from currency reevaluations will be subject to some form of taxation. Investors are strongly urged to consult immediately with experienced financial advisors, certified tax professionals, and legal counsel to plan effectively. Sound tax planning can safeguard wealth and ensure full compliance with all domestic and international financial regulations, transforming this opportunity into a secure foundation for the future.